Hey everyone, my name's Andy. I'm with the Finding Value Finance channel. Today I've got Patrick Karim, NorthStarBadCharts.com. So I've got him on here. I was looking at Twitter and he threw up some really cool charts that I wanted to at least capture his opinion on it. So thanks for coming online, Patrick. Really appreciate it.
Thanks, Andy, for having me on there. It's crazy because, like I said there, you DM me to talk about this, and I was about to record something because I said, man, I told you, I told Kevin Wadsworth, or my partner at NorthStarBadCharts.com, I said, Kevin, tell me I'm biased. Tell me my charts, my lines are wrong, because like there's a confirmed breakdown happening like on one of the leading indicator ratio charts that will show you. And I've noticed that when that confirmed breakdown happens, there's no one doing it. That means eventually right after there's a breakdown versus, I think, the CPI. After that, there's a breakdown, gold, SPX breakdowns versus gold. It's a chain effect. Like I haven't seen a case where we've had this signal and it was not a commodity bull era for like 8 or 10 years.
Yeah. So what gets me about the chart, which is the producer price index to consumer price index, that ratio, is whenever that ratio was performing a certain way, the market conditions or the conditions that were traded at that time were a commodity bull market or a bull market in stocks. So you could see this thing clearly go from stocks to commodities to stocks to commodities as the CPI and PPI ratio move up and down against each other. Yeah. That's what I really like about it. I think it's a pretty reliable indicator. And we were talking about it earlier, the producer price index leading the CPI. And whenever that leads and that ratio is favorable for the PPI, going up at a faster rate than the CPI, that tells us that a certain market condition still exists.
Yeah.
And that's where I was like, this chart is, I think it's really valuable. It could be a buy-sell signal even.
Look, because, or else what I've learned is I used to look at just charts. I was like, when I discovered chart trading, it was just one chart. It doesn't matter the ticker. And I'll just chart it based on classical charting or whatever my framework was. Okay, that was fine, but that was kind of me like surviving because I'm learning a new tool. But I've realized that it's macro, there's ratios, there's cycles. You can't, of course, because that's gonna make the difference knowing in the cycle if you're at a 2011-13 top in gold or the same pattern, similar pattern, like not a newbie, but any chart trader that just looks at the chart says, well, Patrick, it's a breakdown. It's below the 3-year moving average. It's below like horizontal support. That thing's going down to like 1,000, whatever. But it's you can't. That's the nuance of chart trading. Is you have to take a step back and look at these charts. We're going to look and yeah. You want to start digging into a little bit of these? I could.
Yeah,
share.
let's look at that. Let's look at. I know you had a couple like PPI, CPI, and the SPX to producer price index, and I thought those were both. They both tell, I think, the same story, but they just tell it differently.
All right, so let's start with, okay, let's start with the big one there. So, okay, this one, guys. All right. So whenever you look at a chart, it's
not share. You have to share it, I think.
I didn't choose my screen yet. Okay, it's asking me which screen to choose. All right, sorry about that.
Now you're good.
Okay, so SPX, so US equities. I took the SPX. I could have taken the Dow Jones because I have data since 1914, divided by PPI ACO, and that's the producer price index. It's more than the CPI. There's no hedonics, and it's not just input costs. I read a little bit about it. I think it's even like service costs or wages. Or like it's the whole cost of producers. You know, the what it costs them to create these products that we consume. I have the 84-month moving average. So I think that's 7 years. And what else do I have on this chart? I had to put on log scale because this thing has moved logarithmically since 2000, like since over 100 years ago, it just moved logarithmically up. Mm-hmm. So, okay, right now here, I drew a rising trend line. So here's a cycle. So if the SPX is outpacing producer price index, that means you're in a growth stock. There's not like, it's an environment favorable for US equities versus commodities. Inflation sensitive, it's going up, a lot of touches here. Here is a 7-year moving average, which I know it's a good fit because it's moving at the same incline. It's trending nicely. So here's a breakdown. Refused to do a new high, went up violently, breakdown, tried to go back up, a little bouncy here. And after that, once it closes below the 7-year moving average, that's like the death knell. After that, this was a precious, I have other charts. I'll show you the performance of gold, silver, and oil there during this period, but they did pretty good versus US equities. And you see US equities, when adjusted for producer price index, that was a top in 1929. Look, 1962, what is that, 30 years later to break even? So it's tough, unless you have a dividend paying companies and stuff like that there to offset some of that, it's tough. So here, anyways, here, early breakout line, breaks out, retest above the 7-year moving average. Now it's time to go long stocks, go up, up, up. Slowing momentum. Here's a clear breakdown line. 1, 2, 3, 4, 5 touches, breakdown, a small retest, super, super valid. Plus you get a break below that 7-year moving average, which it's also meaningful because it's tracking at the same angle. And then after that, 1969, we know what that is. That's the end of US equities versus then silver, gold, all that. That was the bottom. They start going up. So it goes down hard. The first hit, it goes down hard. You don't know if it's going to go down like 1929 style. It goes down hard. And then after that, there's like a retest. If you can't do a new high on the retest, then that's like the final opportunity. The cycle's 100% enacted. But I haven't seen any of these signals. We'll go through them. That once you have this little warning sign here, the trend line break and the 7-year, it never go in. It's over for like 6, 7, 8 years there. Here's bull cycle, gold. Here, the US equities bull era, 1982, goes up, 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 tracks a 7-year moving average perfectly. 1, 2, 3, 4 touch, tries to go back up, can't do it, break down in 2002. And at the same time, 7-year moving average, the clearest of signals. So even if it goes down here and it drags back up, gold, silver still did very well in the early 2000s and can do a higher high. That's all she wrote. Then after that, the US equities were vulnerable for some other type of drawdown. And remind me to show you a chart after that. I'll overlay the US recessions, and you'll see how this is also a great indicator of the probabilities of if we're going to have what type of recessions we'll have. So here's another cycle, guys. The star in 2011 or 12, this breaks up. You go along US equities, fine, beautiful, beautiful bull run. Look at all these touches to perfection. 1, 2, 3, 4. Clear breakdown. And usually a trend line, 3 touches to make it valid. A break on the 4th, that's it's go time. And this is a break on the 5th. So this is super valuable. And what else? We had a close below also that 7-year moving average. So take a deep breath. For me, this is, I don't know how low this is going to go here. Doesn't really matter. Depends if US equities go like keep crashing now, if PPI stays elevated, it's a ratio. So it could be eventually, okay, if I don't know, it might go down like 1929, but if it goes like in the 1960s or 2000, 1960s, it didn't take too long to try to do a new high. And the 2001, it took a while, right? I think this might have been 2007 or 8, try to go back a new high. But when I see that, as long as you don't break above, we'll see on the reaction high, as long as you don't break above this, like there's always going to be an early breakout line eventually. Why would you go in growth stocks, guys? Like if I'm a fund manager, I see that this is historical 1, 2, 3 times this pattern is repeated. It's not twice, it's 3 times. Clear cycles, 8 to 10 years, no matter how you want to measure that stuff. This is a clear behavior of excesses in one direction, a reset in the other. And right now, this is like, it's like, for me, it's super clear that this is it. Whatever's happening now in commodities, it's not a bear market. Forget that. That's not a bear market. It's the metals sensing that the US equities might go for a down slope, like a 2008 crisis or some type of thing, but they're nowhere close. Like this is not a bear market. We're just starting.
There's a couple of things I want to make some observations on that chart there, if you have there. The cycle, in my opinion, is the real estate cycle. That's the cycle that goes through. That's why you've got these defined things, or the business cycle. The business cycle is the real estate cycle. A lot of those that broke out to the downside. They did a retest move quite quickly afterwards. Yeah, you got two retest moves there, and I think we're going to get a retest move as well. That is the bear trap for commodity investors. They're going to trap all the bears, and then they're going to squeeze them like heck. So I think we're coming up to that bear trap. We've done the first wave. We're going to come back up, and then we'll do a third wave higher in commodities, lower in this. And it's going to get everybody thrown off. They're going to say the commodity bull market's done. It's not going to work. Another thing, if you look at each one of those movements in the consolidation period of the S&P 500 PPI, like those moves lower, you get three distinct humps. You get like a first hump that kind of drops down, and then you get another hump in the middle, and then you get another hump. There's three distinct humps, if that makes sense. So you've got, yeah. They may not be like perfectly flat, but you get like one hump, then you get kind of a head and shoulder type looking movement, and then you get another kind of like just regular hump. That is, you see that all the time in consolidation periods. And another really another thing that I noticed when looking at the chart is every time we've broken it, and you've put it on here, and I think it's important, every time we've broken that trend line, we have not reclaimed it. Like once it breaks, it sits below it for 7 or 8 years. Like that is a very important observation. And obviously you have it on there, that once you break the 7-year moving average, follow rising trends lines well, and it breaks down for a period of time. And that is something that's really important, because we've broken that 7-year trend line, and I don't think we're going to claim it for a while. Like I don't think we're going to go back up there for a good period of time. Another observation I was making when I was looking at your chart is a lot of people say that the market conditions are similar to the 1940s. I disagree, but if you look at the 1940s on this chart, the 1940s was during a breakout of the S&P 500. If you look at the 1970s, like the 1969-70 breakdown, that is what I think is coming for us, because the PPI, the SPX to PPI ratio is telling us that those two market conditions are similar. We're not similar to the 1940s. We're similar to 1970. And that what potentially could be coming is a very big bull market in commodities. And this is another piece or indicator of this. And here's another observation. I know I'm throwing a bunch of observations out there. You can shoot them down or not. More or less, this is more or less charting the margins of companies. Is that a fair statement? So you have the price of the company under certain market conditions. I'm saying, hey, look, I'm making a buttload of money. And then everyone prices it as such in a low interest rate, low inflationary environment. And when that environment changes, their margins compress, the interest rates go up, and all of those things have an impact on the stock, because their margins are going to compress, their earnings are going to go down, and then they go into an environment that's not favorable for stocks, regular stocks that convert, I should say regular companies that convert commodities to usable products. That's the best way I can state it. So when that thing breaks down, it's stating that the market conditions that are coming are not favorable for regular companies and are favorable for commodity type investments. So I saw this. I know I send a lot there and all the observations, but I saw this chart and I'm like, ooh, this is more evidence for what I think is potentially coming. We'll just get a retest move and it's going to scare everyone out. Yeah. Unfortunately.
Yeah. Well, look, if there is a retest move, and there, like you said, there probably won't be, that'll be the like buying the dip opportunity. It's like for those that missed the boat, that'll be it, because after that there'll be what 5-6 years left, or whatever is left. So there's there's not that much time. Look, I'll show you another one. Okay, here with the recessions.
The producer price index was up 11.3% or something like that last month in June. Just the most recent, just to let everybody know, the producer price index was 11.1 or 3. I can't remember.
Year over year, it's like a 25%. I think it's crazy. It's this guys, and I had like, so I don't know how you define stagflation, but I kind of, what I wrote is a series of recessions in an inflationary environment. So you're in an inflation environment. So that means you're below the sleep mode line where PPI is outperforming SPX. And more often than when you're above the early breakout line, when you're in a like maybe disinflation environment, you get more recessions. And I just had fun counting down the number of recessions when you're below that early breakout line. And look here, there was 4 recessions, like in thick ones. And on the way up, like I don't know, it depends where you do your cutoff, but here in this up cycle, like there was only 1 recession, then down. Look at this huge, well, the depression, right? Here, I had 4 recessions in this bottoming cycle. On the way up here, I had 3 cycles. And then when it's a boom era for US equities, there's no recessions, right? Because there are lower and lower interest rates, whatever it is. Look at that here below the sleep mode line. I counted 1, 2, 3, 4 recessions, man, in what? In 8 years? It's crazy. In 10 years? On the way up, look at that, the beautiful bull cycle of US equities. Only two tiny recessions on the way up, or even 1 here. And that one, yeah, I could have marked it as above the sleep mode line. 2 recessions here and a thicker one here. Here we had only 1 recession above the early breakout line. So very like, that's what's March Madness. So that's what's going to happen. Well, the probability, so I'm looking at that. I'm saying we're going to have at least 2 to 4 recessions in the coming, before that early breakout line is broken out. So every time the market tries to go back up, it won't be enough. And the commodity price are just going to smash down everybody in a recession. Oil prices going up. Sorry, you're not getting out of recession now. And they're just going to get smashed a few times, you know? And then after that, once we get those 2, 3, 4 recessions in that 8 or 10 year period, then maybe like we get out. So that was kind of, I kind of find that funny that there might be a higher probability of recessions right now happening. So I don't know how many, but that oil price and all that's gonna, like you said, it's gonna hurt those margins. People won't be able to hire as much people, like whatever, you know, everything's linked, right? So that one was interesting. And okay, we could go. Okay, we'll do this one again, guys.
Yeah, that one's cool.
Yeah. But this was just to demonstrate a point. So I just removed all the noise from the previous chart, guys, from the SPX divided by PPI. I just kept the sleep mode line. That one's exactly drawn the same way. Just to show you guys like what happens to commodity prices. And I just put gold, silver, oil, but I could have put probably some other stuff in there, uranium, copper, like anything that's, when you drop it on your foot, it hurts. And here, guys, I made a mistake. I was too happy to post that there. I could have put the log scale for oil. Oil did make a nice move in that period there. I could probably.
Oh, it's okay. We know it moved.
Yeah, it moved. I have it here.
Just like.
I'll just put a US oil. And US oil did. You see, it moved in the 1940s and went from here. There was 1930 oil went up. Yeah, it was here. 1930 is right here, guys. 1925, 1930 was here. And see how oil went from Jesus. What is that? 60 cents a gallon? 70 cents a gallon?
A barrel, right?
A barrel. How many? Yeah. What is a bit? 70 cents. And then it went up. What? I just want to put in percentage, guys, just to show you the insanity of this move. And then it got up. Put my 280%, maybe more here. Yeah, 230%. So pretty strong move. Actually outperformed gold, went up 100 because it just got repegged. Maybe naturally it would maybe higher, 200% for and 300% for oil. So every time, look, we had these breakdowns, and if like Andy says, we're more like a 1970s type of move. Silver went up, and this is on a monthly close basis. So like the wicks, I don't know, we won't be able to trap that, but so it's like 1,700%, almost 2,000%. Oil did 840%. And these performance are pretty good actually for gold, silver, and oil in a disinflation environment, right? Because right now, if we're like the yields are breaking out of a 4-year channel going down, it's like we're more back like late 60s than we are early 2000s, just because of the fact that everything's breaking out to the upside. So I don't know. Sometimes I see those, well, like, does this make sense? Like, we can't do 1700 again, 1700, like gold. Like, did you imagine that gold going up like 16
I think we
times?
can. I'm in the camp that I guess I'm just a big bull. I think we have a problem in energy worldwide. That's kind of my paradigm, the way that I look at it. And when you have problem in energy, then you're going to have a problem in your PPI and CPI. That's what we're seeing in Germany, because you look at Germany's energy costs, you look at their PPI and CPI, it's going like through the roof. And what happens is your currencies have problems because your currency must grow. The debt of that currency, that has to grow. And if you don't have an accompanying GDP growth with it, you'll get massive inflation. So the market condition, what that's telling us is that the market condition is ripe for money to rotate into these because it has nowhere else to go. That's what I think is going to happen.
Well, yeah, everybody's fighting for the M2 money supply, whatever the money is. And the PPI, SPX PPI chart it's exactly answering you that question. Well, when do I know these capital flows are moving? Well, SPX breaking down against PPI is all you need to know. And the PPI looks more like it's like, it's telling you all you need to know. So
have you tried, and I don't know if you've tried doing this, I don't know if you had a chart. Have you ever tried doing the M2 money supply against GDP? That chart? Because that could tell us if your GDP slows down and your M2 is going up faster, I bet you that market condition would show us that gold is just ridiculous. Is that the chart right there? Nice.
Yeah. So there
it is.
So money supply is definitely outpacing GDP, and it's been doing it like look at that. It's kind of weird, right? 2000, right?
That is so. Oh man. This could basically tell us that we're going into a so what this is telling us is that the number of money units is growing at a faster pace than your GDP. That means that this is going to be one heck of an inflationary environment starting in 2000.
Jesus.
It's just people probably haven't realized it yet.
Yeah, it's
that's a good looking chart, isn't it?
Yeah, this was pretty healthy. So printing money, but you're producing stuff. Because I try to rationalize. People say, oh, fiat currency is just based on trust, but it's based also on production, the GDP, right? Because it's if there's a strong GDP, then your fiat currency is also going to be like, it's backed by more production of your country, its capacity to repay those loans or whatever it is. But this is not good. Yeah, this
is horrible. What this is saying is that we're going to be in some ridiculous inflationary environment. And I don't know how they're going to stop this. So here's another thing. In the 1970s, if you noticed, there was a direct movement in gold and silver when inflation was hitting, when that S&P 500 to PPI ratio broke down, everything moved in tandem. Like, right, yeah, in the 70s there, 60s and 70s, you saw silver have a pretty decent movement pretty early. I mean, it broke down, it paused for a little bit, and then we started to move in those. And I think we're basically like right at that point where gold and silver could take off, hopefully sometime soon. Because you break the line, and then people get aware. That's like the awareness phase of people saying, hey, look, something's different here. You know, we're not used to seeing gas go up this much. We're not used to seeing food in the grocery store go up this much. Now it just has to be persistent.
Well, check it out. This is the killer chart. So this is a chart that's going to answer your question, because I was trying, I don't know when I did this chart, yesterday or this morning. I said, okay, fine. So there's PPI. We know PPI, it broke down versus SPX. SPX, it still hasn't broke down versus CPI. But this, yeah. So I'm wondering right now, I looked at that. So what can PPI tell me about what's going to happen to CPI? Because people, they don't know about PPI, because the CPI is technically like what they feel, like you said, right? The cost of living. That PPI is the producers taking the hit on their margins. Like you said, those stocks, they have to, the market has to downgrade whatever the rating of those stocks, the PDEs, because they They know the margins are going to be gobbled up by increasing input costs.
Mhm.
So here, using a ratio chart, you're able to know. So if this is going up, that means the CPI is outpacing producer price index. So this is pretty healthy for growth stocks. It means that there's no incoming input cost down the pipeline to feed the CPI. CPI is going to go up maybe naturally because it's always queued upwards, right? Because they keep printing money, but it's not going to be like rocket fueled to go crazy because the PPI is subdued. It can't outperform it. But they're both going up at this time. I could have overlaid the CPI and PPI chart, guys. Don't mistake. Your fiat's being devalued. It's been devalued since day one, right? It's been going up like bottom left, top right. It's just us as traders, we want a spot where that's turbocharged. And so we know if we want to be in commodities or we want to be in growth stocks. So here it is, it's outperforming. When it breaks down right here, that means here the PPI is something's up. So the CPI, whatever it is, maybe it's going up, sideways, or stagnates, but PPI says, oh my God, it's going up here. So I don't know what the PPI was back in the early 70s. Maybe it was 4, 5, 6, 10%, 25. It went so high. So that plummets. So that's what I call the setup. So that's the PPI telling you, I have piled up a whole bunch of inflation just in the pipeline. You just don't know yet, but it's there. It's coming your way. And when this goes sideways, this is a CPI catching up to the PPI. So either the PPI stagnates or stalls, or it keeps going up, but the CPI finally, the readings, it's down. It's in the grocery store. The guy had no choice because he was about to close his business, right? He had to put up the prices. And that's where I call the power zone for gold, silver, and all these things. That's when it's just in your face. You say, Jesus, hell, man, this is bad. And this is where you have a chance of having a melt up this is our end game that's going to happen in precious metals. So the steeper this thing is, here's the setup. And even during the setup, silver knows this, like nobody was probably buying silver here as much as they were buying here during the end, right? This is the fear of missing out. This is where people who knew about the chart, they were buying. So let's scoot over all the way back here. Peak 2000. Here down the pipe, PPI was coming down, raining hailstorms, huge move down. Like the move down is violent. It goes down. Then we have the GFC. This is kind of interesting. Is here we have the GFC come up, kind of creating a pulse in here. But if there would be this pulse, I think I kind of have a feeling that it would be still this type of pattern where PPI has semi crashed, and then the inflation that the PPI had still had to be felt by the public. And that's why you get that melt up in silver still after the PPI probably stagnates. You get they feel it, and then it goes up. And then after that, when that starts climbing up for good, you see how silver knows ahead of time that the show's over. It starts climbing up before this thing breaks back upwards. And look what happened today, man. This is crazy. This is as violent or more violent than all of the 70s.
Yep.
or the 2000s. It's more violent. So PPI has just hailstormed its way there. And as impressed as people are with the CPI right now, I think it's double digits, and maybe for a year or two before it cools down any meaningful, look, I don't know how these readings go, but there's so much, the PPI has outperformed so much CPI. It's crazy, Andy. It's hard to wrap my head around this. It's like,
yeah, I know. So I'm looking at this chart and I'm trying to describe it in my head or create some sort of reasoning behind it. So I think the PPI is really like the prices of commodities, but it hasn't filtered, it hasn't flown through the system yet. It hasn't made its way into the consumer prices. I think that's kind of what this is saying, right? So you get this first initial drop of the PPI where the input cost for all these companies is high, but I mean, maybe the power zone is people getting more money in the system. It's like maybe almost a direct relationship of velocity of money almost, or I'm just trying to figure out why that would necessarily be the case, because the CPI is catching up. The consumer price index is catching up to the PPI. That's why it's leveling off. But why would we see a massive move in commodities? And that would be, is it because people can afford more money, that their pay is going up with inflation? I don't know. I'm just
Yeah,
trying
that
to
could be it. Well,
create a narrative to it.
well,
And I don't know what that narrative necessarily is.
well, I have some charts that because I don't mind narratives, but I need to do a chart. So I did
Yep.
one time I did inflation to or PPI to wages, and it's like people know it in their bosses. Like guys they're saying they go to their boss like even last year, hey man, the inflation's 8%. But you know we have to wait until to make sure it's there for good. So it takes time before the bosses like before they actually give the raises to people. And there's so you could see in these inflation environments where the wages start underperform in the beginning, just like this. The wages probably looks like that chart, wages to PPI. Could actually try to do it.
Yeah, because it would underperform in the beginning and then it would
It
catch
would,
up.
and that it's a natural behavior because why the hell would they raise your wages unless like you don't want to work anymore because you can't even live, right? I think I have wages here. It's US. Oh man, hold on, wages. Let me find that because this is gonna be a good chart. I think I did one recently, but
I don't know what the US wages would
or
be.
it's GDI or yeah GDI. I think it's a gross domestic income, so it's all salaries.
Okay.
Or is PPIA? Because if the salaries, everything increases, you're right. It's because of inflation is also driving that. So GDI, gross domestic income. Oh, is it catching up?
There it is.
So the GDI, oh no, that's the opposite. Yeah, this is the first wave. This is PPI destroying wages. So this,
Yes.
for this to, yeah, that's exactly when the wages start outperforming PPI. That's when people put their money in growth stocks. Look at that, Jesus.
Yeah, look at the chart in 2000 to 2008. That's when because it basically leveled off, and that's where we had that big bull in commodities. Is when the money got in the hands of people and got into the system.
So I'm trying, as a technician, I'm trying to see where this could stop. So this is the reverse symmetry move. So here's the base of this. Here did a reverse symmetry move. So this we could be entering the power zone where now wages are going to start coming into the hands of people and they'll be buying houses once again or whatever they'll be buying. Yep. And so this, yeah, here you see, this is a congestion area. So we could be entering, we might be a few months away from entering the zone here where wages, people are saying, look, I'm quitting, give me 10% or I'm out, you know? But you know what they've been doing? They've been giving like bigger bonuses recently. That I've heard that from some friends working for people to stay happy, you know, so they are getting more money. So this is interesting though. So this is an area probably where we're going to go in that region. Look, that was the bull market there for
but notice that this, if you were to plot this ratio against oil, I bet you oil we're gonna have this. Can we do an entire ratio against another one?
Yeah. Well, look, it looks like the oil chart verbatim.
Yeah. The way that moves,
the same
looks
one.
like the oil chart.
It's the same one because they're buying more oil at the pump. I don't know. It's crazy.
See?
But this is another lesson people got to learn, and everything's financialized. Everything is hyper financialized. I don't know what, like, it's why the hell does that ratio look? I'm trying to categorize charts by their type of ratios, Andy. Like, and they all track commodities. Some charts track the oil chart, the inflation stuff. Some charts track the copper chart, like ratios that have other instruments. And some charts, they track the silver chart, or let's say the gold to SPX chart, which is the silver chart. Essentially, the miners won't track that chart. The miners are going to track the SPX to gold chart because SPX breaking down versus gold is opening the gateways to that sector, right? So the miners, all that. But this is pretty crazy though. So does this mean oil is going to slow down here?
I think it's the other way around. I think oil is the one driving the PPI to gross domestic income.
Okay.
I think oil is the driver of it.
Look at that. But not, it's weird,
right? So oil is going to lead it to some degree, and then the other one will. I think. I'm just guessing here.
It could slow down technically here. I don't know how high, but look, at the end of the day, look at the oil chart, because I did an oil chart where, yeah, this one. So quarterly log chart for oil. And look, I drew this roadmap here. I don't know how low it's going to go, but right now it looks like exactly like the transition, like the bear market right now in US equities, or the start of it is dragging down, like that, those recession fears is dragging down oil just like it did in early 2000s. So whenever the Fed pivots, like you said, 1 month, 3 months, like whenever, then this will be it. And then it will go to 140 on the next run up there. But it looks very much like here's the capitulation low in 99. Here's the capitulation low in 2020, explode. So like we could be here. I don't know how low it's going to go, but once we're through this fear, like, look, I don't know, like,
I think that this last one in 2020 is a fractal. You could say that that's wave one of a fractal. That's an upward move. And that compares to 99 to 2001 or so. We're going to get this little pullback. And then the big move that's coming is what's next from 2002 to 2008. That's going to be stacked on top of the right-hand side of oil, which then will blow your PPI through the roof to the upside.
So, okay. So you have oil, which is going to fuel the PPI for some time to come. And we know that will, after that, flow into the CPI. Like this, we're nowhere near, like this is not done yet by any means.
I think oil is going like way up there. Like they'll end the strategic petroleum reserve when that stops and all that stuff goes through. And when the liquefied natural gas terminal comes back online and they build more, we're going to get interconnected to the world market, which is going to push natural gas prices way higher. So with oil going higher and natural gas going higher, your PPI is going to do some crazy stuff. And your consumer price index inflation numbers.
And it would make sense because we're just starting the cycle. So we need that PPI pressure to keep the US equities subdued, right? To keep those hedge fund managers honest and have them allocate, stop buying those growth stocks, start giving a little bit of money to the commodities, right? They have to do their, because they're the big money that's gonna, when hedge fund managers or fund managers are forced to not hold as much, like start holding more like commodity stocks, they're the ones, they're holding the capital flows, right? They're getting them from whatever people. Look at that, 540. If
I know I keep getting numbers in the 500s. I did other analysis. I got like 5 something. I'm like, how the heck do I keep getting $500 something a barrel of oil?
Like, yeah, it depends. Like, I don't know that even if I start this move, let's say I'm conservative. Even if I started down here, let's say we retrace all the way back to $75 there.
Yeah,
it's still hold on, 5. Yeah, it's still a 600% move.
Yeah, still 500 something. I don't know.
And yeah, why not? And look, the more it retraces here, the better it is. It's you need that catapult. Let it look. I just don't want the US equities to go in the bear market. Blah blah. Let them crash hard. And let them deal with their recovery phase. And that's going to fuel commodities out of the gates for a long time. But
it could also mean that like a commodity war is coming or something to do with a war on oil, like Russia and some other war. I don't know. It's just every time I start calculating whatever I use, I get a number that's like up in the $500 range. I don't know. It doesn't matter what it is.
Well, look, I don't know. Sometimes I want to do the devil's advocate and say, Patrick, like, can we just oscillate, go back down to 50, 30, live in there for 20, 30 years again? But that PPI chart breaking down against SPX is like, it's not that, Patrick. Stop it. It's not that. It's there might be a smaller upwave move, fine. But that's not going to survive because that PPI and SPX chart is telling me that that's not how this has played out 3 previous time. And what's driving that chart is those Fed guys or whatever, the macroeconomists, they're creating that move. Whatever, they might not be looking at that chart, but whatever their action is, whatever their playbooks are, to whatever they do, it's like a self-fulfilling prophecy of that chart, that SPX to PPI chart. It's just the nature of the beast. And sometimes I have a feeling, Andy, they could do whatever they want. It's still going to play out the way it's going to play out. It's like, stall it if you want, don't stall it. It's like, I don't know if they like, my only power is looking at the chart and trying to position myself on the low risks, high reward side. And Kevin was showing me some uranium charts, uranium outperforming JDX, uranium. He's like all over uranium. Says, Patrick, man, this is, they're hitting the right side of his arcs. Well, I said, Kevin, as soon as the gold silver ratio starts going down and the market crash and the DXY starts like unwinding, it's gold time.
Yeah. So I'm in all of these assets. I'm in oil, natural gas, uranium, and precious metals. And what I think is going to happen is that they're all going to have their time in the sun all at the same time.
At the same time.
It's going to be like this one goes, this one hits. It's going to be like one after the other starts to turn and head up. And what it's going to be is people, I think, are going to say, look, this is massively inflationary. I got to get my money out of bonds. And bonds are in a 40-year, they're in a 40-year bull market coming to the end of it, which will be starting their bear market. So there's a whole bunch of money to flood over, and it's going to go after anything and everything it can get its hands on, I think.
Well,
so
yeah, I'll show you the just one more chart, man, because there's so much evidence. Like somebody could hear you. I know you do charts, but it's like, guys, look at the chart. Jesus, just is it TNX? TNX, the 10-year yield. Look at this. Look at this beast. Yep. I'm just going to zoom out, reset.
Yep, breaking
chart.
the downtrend.
Yeah, look, it broke out. And I'll put it on the, how do I hide the bottom bar? I hate that. Here, I'm going to remove regular. Okay, remove all drawings.
Just a simple trend line.
Simple trend line, but it's more, look at that. It's a perfect channel. And a channel, when it refuses to retouch the bottom, that means the momentum, it's over. Like these are magnets, right? 1, 2, 3, 4, 5, 6. And to perfection, it's like a robot buying these bonds, right? Like you can't get more perfection than this. And here it refused to touch the bottom, and then it breaks out to the upside. Double whammy. This was already a warning sign, and this, it's a done deal, Andy. It's the 40-year bond market is broken. It's done.
Yes, I agree.
So now a pullback, fine. Like maybe they do QE and they do some yield curve control for a while.
Recession.
Recession.
Fear,
yeah,
could be.
Whatever reason, this is a beautiful TA. Like you don't always go to the moon right away. Yep. This is a very probable type of roadmap here.
Yes,
but this moves down in yields, especially with all the inflation we have. Gold is going to go ballistic.
Yeah,
this can make gold go bonkers there.
Well, I think gold's going to go ballistic even if the interest rates go up. Because you're going to have this massive real negative rate. People are going to get scared. They're not scared yet. They think it's all temporary. Once they figure out it's not. And what the leading indicator I think that you charted was the M2 money supply in relationship to GDP. That chart there should hold far more weight than what most people understand. Because what they did is they put the money into the system. They flooded it into the system, and it all went into stocks and bonds. In 2008 and 9, when they created all that stimulus and recapitalized the banks, it all flooded over to stocks. That's why the stock to commodity ratio got so far out of whack. Now, under different market conditions, they have way too much money in the system. And they're like, crap, we can't have this money rotate over. It's going to create massive inflation if this money goes and seeks, commodities and hard assets. Because then the money is now seen by everyone. Yeah, it's not just in the system hidden in equities.
Yeah,
it's going to come out.
Hard, and it's hard to phantom those numbers in the U.S. equities unless you talk to somebody who's trading these growth stocks. And for him, a small company is 100 billion. It's like I have some friends like they play. For them, they aim a 10 bagger for a company going from 1 billion to 10. For him, that's easy. Jesus, imagine that in the minors. It's like the end game goal is having a company that becomes 1 billion, right? It's like there's so much money sloshing around in US equities. It's unfathomable.
Well, if the market conditions get right enough where we get these imbalances in commodities and they get large enough, what's going to happen is it's literally going to kill those companies, because they're going to say, I want to convert this commodity to a product. Give me the commodity. And it's like, it's not there. It's not there. It's not there. And they're looking to the right, like, where are all these commodities? And they're just getting choked from that aspect, which then chokes your GDP. If your GDP gets choked, at the same time that the design of your system, your currency system, continues to ramp higher, you get that ratio of M2 money supply in relationship to GDP goes out of whack, which means it's going to be incredibly inflationary, which then drives all the money towards commodities. So you get this like gigantic, I don't know, like self-feedback loop where the money just keeps feeding into commodities and they're like, I can't be in bonds, I'm losing money. Go put it into commodities, and then it goes up even more.
That the GDP chart to M2 to GDP, that was on the log scale. It was hockey stick on the log scale.
Yes. Hockey stick on the log scale. That's why I was like, holy, something's wrong.
Well, that's endgame, right? So that's a
That is
endgame move.
It could be.
It could be.
Because
let me just pop it up real fast again.
Because what that is telling us is all the way back in time that our economy was more efficient at putting products into it than it was creating M2 money supply. So your costs would be roughly the same or go slightly lower of regular mass produced items. This is telling us that we've got money creation and our GDP is either screwed up or our inputs are screwed up or something's screwed up.
Hold on. There's another chart, the currency in circulation, which is a little bit different than GDP. Look at that. But I'm just curious. I just want to see if the GDP, that's the actual data, because sometimes when you do a ratio chart and you have to make sure that both. Okay, perfect. See, I have a data series from 1940s, currency in circulation. I have data series. Okay, perfect. So they're both going up, but you're right. Racial charts will tell you the truth. This is insane. So you see there's a game change. Look at that. That's crazy.
In the early 90s is when it really...
Yeah, 90, and that's when this thing broke out there.
So really what we're doing is we're just basically creating currency at a faster pace and exporting all of our inflation to other countries. And then we're buying all their products.
Deflation. So let's say people would go bankrupt like crazy, right? It would create this, right? But maybe not. Like
your M2 money supply. Yeah, that's what that is the housing market crash.
2005. It topped. Well, hold on. 2003.
It was growing slower than the rate of GDP.
Yeah.
So your housing market crashed during that time frame. It was slowing down and then crashed from 05 onward.
Okay.
Basically.
Got it. So something really changed back here, but it's weird because this thing was going down in the 70s and the metals did fine also. But this is it.
And that was an artificial pump that we had, that big M2 money supply pump recently.
I don't know what to make of this, Andy. This that's an awkward look. That's like a perfect arc practically.
Mm-hmm.
Well, the destiny of an arc is it's the origin. Look at that, perfect touches. 1, 2, yep. 1, 2, 3, 4. Let me raise that. Look at that. So it's about, this is telling me that it's very close to having another leg up. So more money printing than what GDP can economize. Or that's it. Yeah, that's it. GDP won't be able to outpace. So the destiny of this chart is another leg up right here. I don't know what it would have looked like up here, but this is pretty.
Yeah, it's going to be probably more inflationary.
Well, yeah, we keep collecting the evidence. I keep looking at the charts, and until that PPI, until SPX breaks out versus PPI once again, I know where my investments are going.
Yeah, commodities and precious metals and.
Yeah, hunt for those in that sector. Look for ratios. Yep. Like have your fun, but going in the high PE stocks, there it's like, what are you doing?
Right. Agreed. So do you have anything else to share? Anything else? I mean, I don't really have much. That was a lot of good stuff.
Yeah, no, that was a good information. I'm happy there that we get to spread the word there on this, Andy, there, because it's just the beginning, and people got to stop looking at the screen like that there. Like we're doing macro stuff, man, showing you where the trillions of dollars are heading next. Like, don't fight that.
Right.
Yeah, because
Those are great charts. I mean, thank you for sharing them,
Thanks.
Patrick. Really appreciate it. I saw them on Twitter and I said, I got to call you, get you on here, get you on, get up for a call. So, yeah, definitely. Thank you for coming on. Thanks for sharing all that information. It's I think that was a ton of value there that I don't even think people realize how much value was in this discussion.
Wow. Yeah, share the link to that one tweet there.
Yep.
So if it could go viral or something, maybe it'll help
Oh yeah,
people
I
just
shared it.
understand.
Yep.
Because I have been accused, like my charts are not the easiest to understand, but just the way you hashed it out, you explained it, you might help crystallize with the message I'm seeing, that we're both seeing, but your viewpoint, your viewers, they understand how you think. So hopefully that's gonna, if it crystallizes in their head, they'll be able to explain it to a family member, and hopefully this is gonna just like everybody will be aware,
Yeah, that was great. So how can people contact you, just in case they want to contact you if they are interested? Twitter,
Yeah, well,
and
yeah.
your website.
Well, like, yeah, Twitter guys, Bad Charts One, all this big picture stuff, it's all there. And NorthstarBadCharts.com with Kevin Wadsworth. He's a North Star Charts on Twitter. We have a website. There's actually a 60% off right now on yearly subscriptions. So if you want to encourage us, it's over there. Lots of value there. And on Twitter also, guys, it's all free. So enjoy whatever you like.
And it's right here, at Bad Charts One.
Yeah.
If you want to add them.
And I'm not removing those silver coins until it's the end of the bull era.
Okay.
I don't care how those silver goes there. It's until the SPX breaks out versus silver there, those coins are staying there. What? Am I going to regret saying that? Maybe I'll change them. Who knows?
No, it'll be good. I think it'll be fine.
I want to put oil barrels and uranium. Like I want to do, like, it's not just silver, guys. It's symbolic. It's more than silver. It's like everything that Andy mentioned, right? Uranium, oil, like choose your poison there, whatever color you like.
Yeah, mine is platinum.
There you go.
I like platinum right now.
That's platinum too, man. That's nobody's talking about that platinum stuff, man. But it's 850 spot price there. That's pretty cheap.
Yeah, I like the platinum. I know you like silver, but I like the platinum. So, all right, that's all I've got. So thank you, Patrick, for coming on. Really appreciate it.
Thanks, Andy. Take care, man.
See ya.